So welcome to day 2 of our strategic financial management class. In the yesterday's class, we have discussed the basics of everything that we need. So our way is to first build a foundation, and based on our foundation we will be building our concepts one by one. So that is how the flow of the class will be. Are you all with me? Say yes, no. Very good, Pa. Very good. Super. Okay. So with this attitude, let us start today's class. So in the yesterday's class, we have discussed the basics. First, what is financial management? Management of money. That is what is financial management for any business. Okay, we are not seeing personal finance. So management of money for any business is financial management. So what we will do in financial management? In financial management, we will be taking decisions. Sir, what decisions you will take? We will take investment decision, financing decision, and then dividend decision. A basic of all the three you have studied in your inter. Now, sir, how to take the decision, or why taking decision is very important? Why taking decision is very important? To achieve the objective of financial management. Sir, what is the objective of financial management? The objective of financial management is maximizing the profit and maximizing the wealth. These are all the things that you would have saw in inter. I am just revising it. So okay, sir, maximization of profit and maximization of wealth. Sir, how to take a decision? We will have to take calculated decisions. So we are having lot of techniques. We will apply some techniques, we will calculate, we will analyze, and based on the decision rule we are going to take a decision. For example, NPV means the highest NPV project we will select. Payback period means the lowest payback period we will select. IRR means if the IRR is more than the cost of capital, we are going to select the project. So based on these things we are going to select the different projects. Now, calculated decisions, whenever I tell that we have to take calculated decisions, and the calculations, everything you have studied in inter. Abasar, what we are going to do in final? We are going to do in final is that we are going to apply all the concepts that you have studied in inter at a very advanced level. That is number one, as far as investment decision is concerned. And then we are going to touch upon core finance. Sir, what is core finance? Core finance means finance related to equity, debt, stock market, capital markets. So the finance related to capital markets is the major focus area of CMA final. I will just show you, okay, how we are going to bridge the gap between inter and final. Okay. Now you see at an inter, so this is the transitioning from the intermediate to final level. At intermediate level, we were more focused on corporate finance. Sir, what is corporate finance, sir? Corporate finance means finance for the business, which means investment decision for the business, financing decision for the business, and then dividend decisions for the business. Those were the major focus area that you were seeing. Working capital management for the business. So those were the major focus area that you were seeing at an inter level. So that is what we will call it as corporate finance. Okay, so financing decision, investment decision, dividend decision, and working capital management decisions. These are all the things that we have seen at the inter level. Sir, how we are transitioning from the inter to final level? Here we are more focused on investment finance. It is also called as the core finance, because currently, see, finance is an ocean. And let me tell you, whatever you are studying, right, it is just a droplet in the ocean. Or just for you to imagine, after you do this course, like how first we will do doctor, which is MBBS, and once we complete the MBBS, we are having specialization courses. ENT, only eyes, nose, okay. For heart we are having a separate study. For brain we are having a separate study. For skin we are having a separate study. Gynecologist, dermatologist, okay. Lot of different areas of specialization is there. Likewise, even in professional course, so CA, CMA, CS, so these are generic, which are having basic things. For I am not telling, okay, which means CMA is more focused on cost management. CS is more focused on secretarial practice. All the corporate things and all corporate and legal matters are handled in company secretary. Chartered accountants are more focused on audits and taxes. Okay, so these are all the focus area of different courses. Here you will be learning all the things in general and one focus area. Okay, that is what this course. Now if you want to do a specialization, okay, there is a separate course which is called as CFA. This is separate specialization in finance, because the meaning of CFA is uh, uh, chartered financial analyst. So like how chartered accountants is that, like we are having chartered financial analyst. So this is one international course which is a specialization in finance. In finance itself, there is a separate topic called as risk management. For that also there is a separate course which is called as FRM. Okay, which is called as FRM, financial risk management. So we are having lot of courses like this that focuses on specialization of all these things. Now why I am telling all this about specialization is that in finance is bifurcated into lot of branches. So one is corporate finance and one is core finance. So I have given the specialization of finance. You see, corporate finance we are having, personal finance we are having. Okay, so corporate finance means finance for the business. Personal finance means finance for my personal things. So for my marriage I have to finance, for my kids I have to finance, correct? I have to think, right? I have to budget plan. So all this comes for personal finance. Public finance, finance for government entities. So for state government budget preparation, okay, central government budget preparation every year, okay, Nirmala Sitharaman, green and red saree ported, they will come, right? So all this comes under public finance. Then we are having investment finance, the finance for capital markets, and this is the huge area. It is a huge area. Investment finance or core finance is the huge area, where because we are not having one product, equity is one product, right? Adhe mari we are having equity product, debt product, bond product, convertible debentures, okay, futures, options, commodities, lot of things are there, lot of products are there, and how to see all those products differently is something that you're going to see in core finance. And core finance is the main finance area where you as an individual, okay, I'm talking about you students as an individual, have a lot of potential to earn a lot of money if you understand the core finance properly. And then we are having international finance. So international finance, all the cross border finances will come here. Then these are, the modern finance that has slowly, okay, slowly been emerged. Behavioral finance, because finance is not plain. If this is the thing, then this we have to do. If this is the thing, then that we have to do. Okay, it is not x is equal to y. Finance is always a gray area. Okay, so that is the reason sometimes behavior also play a lot of time. For example, in the COVID time, the investment patterns will be different. Okay, in the war time the investment pattern will be different. Okay, in any other situation, investment pattern will be different. It will be different country by country, caste by caste, state by state, culture by culture. So all these things comes under behavioral finance. Because if you see in Gujarat and Maharashtra, they will be very much, okay, very much dependent on the passive income. So they will always look for a passive income, as compared to if you see South India, they are not very much compared to passive income. If they are having extra money, they will purchase gold and real estate. But if you see in Gujarat and Maharashtra and all, if they are having extra money, they will go and put it into the markets. So all this comes under behavioral finance. So here there is no rule. For them also stock market is the same, for us also stock market is the same, but we see stock market as different and those people see stock market as different. I'm just giving you a basic thing. And then this is the new thing which is called as quantitative finance. Now all these things you will not see in your CMA final subject, okay? All these things you're going to see only in the specialization things and all. But I'm just giving you, I'm just planting a seed. Like if you are having interest, you can also, look at what is behavioral finance, what is quantitative finance. So these are some of the interesting areas. Sir, what is quantitative finance? The finance where statistics and probabilities are used widely, which means, currently, so just to give you an example, we have lot of hedge funds and all. So what hedge funds do is that they will trade in heavy quantities. Okay, they will trade in heavy quantities. They are not individuals, they will trade for arbitrages. Okay, you're going to see what is an arbitrage. And hedge funds and all are those people who will trade for 1 paisa, 2 paisa and 3 paisa and all. Now we will not be trading for 1 paisa, 2 paisa, because our brokerage charges itself will be gone. So they are the people who will trade for 1 paisa, 2 paisa, but they will trade in crores of quantities. So it is called as HFT, which is called as high frequency trading. Okay, so for high frequency trading, you should be knowing what is the risk involved. So the standard deviation, coefficient, regression, lot of stochastic models are there. So those models are built only for quantitative finance. Okay, so these are some of the interesting areas that you could see in finances. Now, sir, our subject, okay, for CMA final is concerned, it is more focused on core finance, and our CMA Inter was more focused on corporate finance. Okay, so CMA Inter was more focused on corporate finance, and CMA final is more focused on core finance. Just to give you an overview, a picture of what you're going to see. So I'm just defining our borders, and we are going to stay within those borders. But wherever any other application comes, it is my job to raise or increase the curiosity in you. A teacher's job is to increase the curiosity in the students. See, yesterday only, I was just in Instagram. So a teacher has kept some story. So I have also reposted it as a story, and it says that the person was telling that if you are having a bad engineer, probably you will be at a loss of 10 to 12 buildings. Okay, he will just make worst 10 to 12 buildings. If there is a bad doctor, okay, so 10 to 12 patients will get affected. But if there is a bad teacher, then the generations after generations will be getting affected. So a teacher is such an important profession. So that is the reason, like, it is not my words. Okay, it is not my words. So I'm not remembering. It was an interview of, I think, yeah, Amir Khan. So he was telling, okay, so a teacher, the best minds and the best hearts should be in the teaching profession, so that the people's career will be made, because a teacher is a person who will affect the generation. Just think about it. A person who is uneducated, but because of some good teacher, if he is having the curiosity, now a teacher will not teach for LKG to 12th standard. There will be some moments, okay, there will be some moments where the curiosity will be ignited inside you, like how Abdul Kalam sir said that ignited minds. Okay, so his work was only to ignite the curiosity. So once you ignite that curiosity, that person will become knowledgeable automatically. So slowly he will gain resources and he will become knowledgeable. And if he is educated, his entire generation will be educated, because he will know the value of education. So that is what is the role of a teacher. So a teacher, if there is a bad teacher, the entire generation will get affected. But if there is a good teacher, the entire generation will be affected by his good deeds. That actually touched me, because really a teacher's profession is so noble, that a person who is teaching, so from there, and even previously I always say this thing, my job is not to teach this subject of CMA final. Okay, my job is to ignite the curiosity in you. The subject knowledge you will automatically get if that curiosity is ignited. So that is the reason I am not directly reading line by line the study material. I am not only solving the study material, I am actually explaining you everything, because just in case, even if one student's curiosity is ignited, tomorrow he may write some theorem, he may make some models in finance. Okay, and tomorrow he will give a speech. If he gets a Nobel Prize, he will get a speech and all. All this is because of Tawfiq sir. See, I am having high stakes on you, pa, okay, wa? So I hope you all stay with that. Are you all with me? Yes, no? Okay. Moral of the story. In CMA final, your major focus is core finance. Core finance means investment finance, which means finances for capital markets. Capital market means the market from where you can get the capital, either equity capital or debt capital or any capital for that matter. Okay. So in the yesterday's class, we have discussed a lot of things. We have discussed what is time value of money. We have discussed inflation. We have discussed discounting, compounding, and from the discounting, I have told you that always you have to discount cash flows and you should not discount profit, because cash flows are more superior than profit. Sir, how to calculate cash flows? All the things you have studied in inter, but still we are going to see again in the final level also. Then I told you what is investment decision. Investment decision means how to take a decision. Okay, investment decision means how to take a decision. How we have to take a decision? We have to take calculated decision based on a lot of techniques. So these are all the techniques of capital budgeting. So we are having non-discounting techniques, where we are having payback period and accounting rate of return. And then we are having discounting techniques, where we are having discounted payback period, net present value, profitability index, internal rate of return. And these are all the advancement of NPV and IRR, which is modified internal rate of return, modified NPV and adjusted NPV. These are all the things that you're going to see at your investment decision chapter, and lot of other things. Okay, these are all the basic things that you have already studied, but we are going to again brush all the topics. Okay, now first one. So I want you to have a notebook with you. Okay, I want you to have actually 2 notebooks with you. In one notebook, whatever you're doing in the classroom, you just do it. Okay, whatever you're doing in the classroom, you have to do it. That is what is your first notebook. And in your second notebook, okay, in your second notebook, you just have to summarize whatever you studied in that one. For example, today you have written 10 pages. So the gist of the 10 pages you will write in half or 1 page. Okay, so day 1, the summary, you will just write it. Day 2, the summary. Trust me, in before the examination, your classroom note will be some 250, 300 pages or 200 pages if you're writing the class properly, or if you're attending the classes properly. And before the examination, it is impossible for you to revise those 200, 300 pages before the examination. So there what we will be helpful is that the summary notes that you are yourself preparing. Now, lot of faculties, how they do is that they spoon feed the students a lot. They will give everything, chart book, summary book, question book, this book, that book, everything. Okay, everything they will give, and they will tell, okay, but they will tell that nothing you should be doing. So that will make the student lazy, and second, the writing habit is gone. Okay, the note making habit is gone. But the habit of note making is very important. So that is the reason I will give you notes and all. Okay, but that is not a problem, that I will give you notes and all. But I always believe in writing your own notes, because if you are writing your own notes, there is nothing better than that. Okay, there is nothing better than that. Now, so I want you to keep 2 notes. One, whatever you're doing in the classroom, you just write left, right. Okay, even if you're doing a mistake, don't worry. You cut it and then you write it again. Sometimes what I will see is that, especially girls and all, what they will do now, whenever they are trying to do any solve. For example, I've given you some problem. Hey, solve it. Try to solve. So what they will do is that they will first do it in pencil, and then they will check whether they're getting the answer correct or wrong. Afterwards, if they're not getting the answer correct, they will erase it. They will do it again. So like that and all they will do. Okay, what I used to tell is that you do it in pen. I want you to make mistakes. You are making a mistake, cut it, no problem. Okay, I know that, okay, you don't like striking in the book, but don't worry, that's the hard thing that one can do. You strike, because your mind should know that you have done wrong. Okay, the next time when you're seeing the book, then what will happen? Then you will do again. Okay, then you will do it again, and then again you will do a mistake. Again you cut it, again you write it, because this is something that you should be doing it. Okay, that is something that I believe in, because if you're cutting and doing it again, your mind will know that you did some mistake, and if possible, write what mistake you did, so that next time whenever you're just seeing what is the mistake. Because doing one time is called as a mistake, doing it again is a blunder. So you make mistakes. Okay, you are making 100 mistakes, I don't have any problem, but you make 100 different mistakes. Okay, every time one innovative mistake you do, I'm very much happy. Okay, I'm very much happy, because doing mistake in the classroom is far better than doing mistake in the examination hall. Okay, so do mistake here, prepare for the examination now itself. Okay, do 100 mistakes, so that all the mistakes you have tried and tested in the examination, you don't have any mistake to do. Still you are doing a mistake, that is a blunder. One mistake should not be repeated. Clarity? Okay, so 2 books. Okay, one, you write whatever you will be doing in the classroom, and the second book is the summary book that you have to write it on your own, or first you write it the summary of all the, okay, whatever you are studying today, you just write a summary. For example, some important formula, some important adjustment, okay, some important comment, whatever, okay, just a one class should be summarized in half page or 1 page. That is what is the summary book. Are you all with me? Will you all do this? Trust me, pa, okay, if you trust me, you will have a lot of profit in terms of marks. I'm telling, pa. Are you all with me? Do you all trust me, pa? My dear Chalakutis? You all are not reaching my expectation. Yeah, everyone. Yes, very good. I want response from everyone. That is my bare minimum expectation that I'm having from you guys. What more I can ask for? And don't forget, you all are committed. Okay. Super. Very good, pa. Very good. Okay. So, first, let us see all the techniques one by one. Okay, well, let us see all the techniques one by one. Then from those techniques, okay, I will be framing examples, and then I will be giving you one by one problems and all. Okay, we are not directly jumping into the problems. First, we will make our core concepts ready. Once the core concepts are ready, then things becomes very simple. Okay, wow. So first, I have also framed some questions for you. So let me take those questions with you. So that becomes very much simple. Okay, so first write the heading as payback period. Okay, write the heading as payback period. It is one of the technique of capital budgeting. Okay, you all know, okay, what is the importance of technique, because that will help you take a decision. So these are lot of techniques. Everyone will be having their own techniques of dealing, right? So I will be telling you all the famous techniques. You can create your own techniques also, and you can come back to me, sir, I've created a new technique. Using this technique also we can take investment decisions. You come to me, no problem. Who knows, that will be incorporated in your CMA final in the next attempt, and you may get a Nobel Prize, and you can give a speech. Okay, so payback period. Ready? Okay. So, see, usually I give this example. Whenever any proposal come to you, again, not a marriage proposal, a business proposal, you have to take a decision. For example, you are having proposal A and proposal B. Now, which proposal you are going to select? Now, that decision you have to take. Okay. So, for that different techniques are there. So, one of the technique is payback period. And these investment decisions are basically the business decisions that we have to make. Now, usually behavioral finance, I'm telling you, usually these Gujaratis and Marwadis and all make very good business decisions. You see, all those people will be businessmen. Okay, all those people will be businessmen. They'll be very much rich, though they don't look rich. Okay, they will all hide their money and all. Okay, if you go and ask them, hey, I want 500 rupees, they will not give you. Okay, they will tell that I don't even have 10 rupees, but actually they will be having crores of rupees that you will not be knowing. Okay, so just okay, all these are behavioral things and all. So why I'm telling this is that they are having good business sense. They don't even need a calculator to take decisions. Now, if you get some proposal in front of you, you will ask all the questions, then you will go home, you will write an Excel, you will calculate NPV, IRR, blah 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 blah, and then you will take a decision. Okay, a Gujarati will take a decision in just 5 seconds. Tuck tuck tuck. You just tell them, okay, this is the cash flow of A, this is the cash flow of B. He will take A, I will select this. Okay. Now, you have to, why I am telling now, because somewhere I am also Gujarati. So my mother is from Maharashtra family. My father is from a Gujarat family. So Gujarat, Maharashtra. I am born and brought up in Chennai only. Okay. So it's not that, okay, I came from there. I am born here from LKG to 12th standard. I have studied in Chennai only. So I am having all the Chennai vibes. My mother will be having the Maharashtra vibes. My father will be having the Gujarat vibes. So that is the reason, in my home, I have tasted everything. I have tasted Gujarati dishes, Maharashtra dishes, and South Indian. My mom has also learned how to cook South Indian and all. So everything, daily yummy, yummy and good food I will have. So whenever my Tamil friends will see my lunch, they will all say, hey, how you are making daily chapati and all. Hey, how you are making this, that. Hey, you are bringing. Oh, you will do pizza in home. Oh, you will do burger in home. Usually Gujarati people and all will do everything in home. They will not eat outside. Or even if they're eating outside and all, they will not have the normal rice or everything. Okay. Now, why I'm telling the Gujarati mindset is that what they used to do, okay, they used to do is that they always used to think, when will I get my money back? Okay, wow. For example, I am going to a person, okay, a Gujarati person, and then I'm going and I'm asking him, hey, I'm having an investment proposal in front of me. I will give you 1 lakh rupees. Okay, I will give you 1 lakh, sorry, you give me 1 lakh rupees, and then I will give you 30,000 rupees for the next 8 years. Okay, I'll just note it down. So, which means what? 0th year, you give me 1 lakh rupees. Okay, 1 to 8 years, I am going to give you 30,000 rupees. So 1, 2, 3, 4, 5, 6, 7, 8 annuity cash flows, right? Because all are annuity cash flows, I can write like this also. Okay, so this is what is the cash flow pattern. Okay, this is what is proposal A. Now imagine if I give this to you, what you will do? You will calculate IRR, you will do this, that, NPV, all these things you will do. Okay, what Gujarati will do is that he will just check. Okay, he will just tell, okay, in his mind voice, I'm telling Gujarati's mind voice, he will always tell, or Marwadis will tell, mera pissa kab wapas aayega. Okay, you can tell pissa kab wapas aayega. It means, when will I get my money back? You even ask a loan, okay, any Marwadi person, you just ask a loan, hey, I want 100 rupees. They will tell, pissa kab wapas aayega. When will I get my money back? Okay, I don't worry about anything. When will I get my money back and how much interest? That are the only questions that they are going to ask. Pure business people, okay, you don't even, you cannot even handle. If you see South people and all are very sweet, okay. Whenever someone is asking money, pa customer, okay, in the vechiko, okay. But no, if you're going to asking from Gujarati and Marwadi, it will never happen. Okay, trust me, personal experience. Not that I have asked and all, or not that I have not given, okay, but I have seen my friends and all. So what he is going to think is that, when will I get my money back? So it means he will see that, okay, 1 lakh I'm giving. First year how much I'm getting? 30,000. Okay. Have I got my money back? No. First year I didn't get my money back. Next year how much I'm getting? Second year. Okay. First year I'm getting 30,000. I didn't get my money back. Second year I'm getting 60,000. I didn't get my money back. I've invested 1 lakh rupees. Third year I'm getting again 30,000. So this becomes 90,000. So again I'm not getting my money back. Okay, let me keep it as 1,50,000. Fourth year I'm getting 1,20,000. Had I got my money back? No, I didn't get my money back. In a 30, 60, 90, 120, I got only 120 lakhs. Sorry, 1,20,000. But I have invested 1,50,000. Still I'm at a loss. Fifth year, how much I'm getting? 1,50,000. How much I have invested? 1,50,000. So I got my money back. So which means, when I'm getting my money back, mera pisa kab wapas aayega? When I'm getting my money back, I'm getting my money back in the fifth year. Then he is going to see, here I'm getting my money in fifth year. Had I invested in some other business, I would have got my money back in 3 years itself. Whatever I'm investing, I would have got in 3 years. So no. Now this calculation, how much time will it take? Okay, it will just take around 5 seconds. Okay, 1,50,000, 30,000, 30, 60, 90, 120, 150. Fifth year I'm getting my money back. No, pa, my business will pay back me in 3 years. So no, I don't want. But if you give them an offer that I will get your money back in 2 years, then they are going to invest. Yeah. So how much time they are taking? They are taking only 5 seconds of time. Now all these calculations are mind calculations which they are doing. Okay, all these calculations are mind calculations that they are doing. Now whatever the calculations that they are doing, मेरा पैसा कब वापस आएगा? In financial management terms, it is called as payback period. It is called as payback period. And how we have to calculate payback period? The meaning of payback period is that, okay, how much time? The meaning of payback period is, okay, so first the meaning is, when will I get my money back? When will I get my money back? So payback period answers this question. When will I get my money back? So always the answer will be in years. Okay, years or months. Now, what is payback period? The time required to recover the initial investment. Okay, initial investment, or it is also called as initial cash flow. Okay, initial investment or initial cash flow. So the time required, okay, so the time required to recover the initial investment or the initial cash flow is the payback period. Okay, that is what is the textbook explanation of payback period. But you know how to calculate. Okay, you know how to calculate. Sir, now how to calculate this, sir? Let me bifurcate the cash flows into two. One is annuity cash flows and the second one is uneven cash flows. Okay, annuity cash flows and then uneven cash flows. Okay, sir, what is the example of annuity cash flows? Just we saw, right? Just me write me and give me an, let me give you an example. Initial cash flow is equal to 1,20,000. An annual cash flow for 5 years, okay, annual cash flows for 5 years is equal to 30,000. Understanding? So how we will write this? We will write it like this: year end cash flow. Sir, year 0 initial 1,20,000. Okay, year 1 to 5, how much I am getting? 30,000. Okay, 30,000. Okay, now when I am getting my money back, basic, we are having a formula for payback period. We are having a formula. Hey, this formula means you don't have to mug up and all, just understand the logic. So the formula for payback period is equal to initial cash flow divided by annual cash flows. Sir, how much is my initial cash flows? 1,20,000. How much is my annual cash flows? 30,000. So what is 1,20,000 divided by 30,000? Everyone quickly. How much 1,20,000 divided by 30,000? 4. So this is 4 years. Okay, this is 4 years. Are you all understanding? Sir, what actually is happening in the formula? 30,000 you got. Second year 60,000 you got. Third year 90,000 you got. And fourth year 1,20,000 you got. So because all the cash flows are same, you're just dividing, so you will get the number of years. So this is what is the basic of what is happening in payback period. Okay, if it is an annuity cash flow, how to calculate? This is how you will calculate the payback period. If you are understanding what you have to do, everyone, if you are understanding this, what you have to do, my dear Chalakutis, I want clap emojis. If you're understanding, all virtual claps I need. A magician is showing some magic, what you will do then? Like how every magic will have a trick. So here also every magic will have some logic. Okay, nothing is magic, everything is logic. Okay, now let me give an example for uneven cash flows. Okay, now let me get at uneven cash flows. So example, uneven cash flows example is your initial cash flow is equal to 1,20,000. So uneven means the cash flow are not annual. So annuity, it is not annuity cash flows. Annuity cash flows means every year same cash flow. Uneven cash flow means every year different cash flow. So here your cash flow is year and cash flow. Here also 1 to 5 years. 1, 2, 3, 4, 5. But here the cash flows is first year 20,000, then 30,000, then 40,000, then 50,000, and then 60,000. Now this is what is the cash flows. Now this is an example for uneven cash flows. Why uneven cash flows? Because every year the cash flows are not even. Every year the cash flows are not same. Uneven. So that's the reason we will call it as uneven cash flows. Now sir, how to calculate a payback period for this? Okay, how to calculate payback period for uneven cash flows? Okay, how to calculate payback period? Now, because the cash flows are not annual, you cannot write a formula. But the same logic, you know, right? The logic means first year how much I got, second year how much I got, third year how much I got. The same logic you will write it in the table format. So I will just give you year, cash flow, and then there will be one column called as cumulative cash flow. Sir, year 1, 2, 3, 4 and 5. Year 1 the cash flow is 20,000. Here it is 30,000. Here it is 40,000. Here it is 50,000 and here it is 60,000. Sir, first year how much money I got, sir? Okay, first year I got 20,000. Okay. Second year how much I got? I got one more 30,000. So total how much I got? I got 50,000, sir. You know, right? 20 plus 30. Understanding? 20 I got. Now 20 plus 30. So it is nothing but subtotal. Okay. Till this it is 30, 50. Okay. Till this it is 50. Now 50 plus 40 again 90,000. Because third year how much I got, sir? I got 90,000 rupees. Now next fourth year. Fourth year how much I got? 90 plus 50, 1,40,000. Fifth year how much I got? 2 lakhs. Okay, this is what is the cumulative cash flow. Now, had my initial investment is 1,40,000 rupees. Now understand, had my initial investment is 1,40,000 rupees, I can tell that, sir, in fourth year I got 1,40,000 rupees. So that is the reason my payback period is fourth year. Had my initial cash flow is 1,40,000 rupees, my payback period is equal to 4 years. 4 years if my initial cash flow is equal to 1,40,000 rupees. But actually, what is my initial cash flow? My initial cash flow is 1,20,000 rupees. So now what I have to do? Everyone understand? Now what I have to do? Okay. Now, very interesting. Sir, I want 1,20,000 rupees. So where I am getting my 1,20,000? Third year I am getting only 90,000. But fourth year I am getting 1,40,000, which is more than 120. So somewhere between 3 and 4 I got that 1,20,000 rupees. Understanding? Somewhere. So you understand the logic first. So the logic is that I want 1,20,000 rupees when I am getting 1,20,000. Sir, first year end I got 20,000. Second year end I got 50,000. Third year end I got 90,000. Sir, third year 90,000, sir. Fourth year end I got how much? I got 1,40,000 rupees. So actually I want 1,20,000 only. So fourth year I got more. So somewhere between 3 and 4, this 1,20,000 is lying. Sir, which means after 3 years, there is 3 years, how many months? Now you have to find, right? 3 years, 2 months, 3 years, 3 months, 3 years, 4 months. So 3.1, 3.2, 3.3, where? Okay, where it is falling. Now that you have to see. Now you just understand, after 3 years, how much more money you want? 90,000 you have already recovered, but how much you want to recover? You want to recover 1,20,000 rupees. So how much more money you want? Everyone answer. 90,000 you have already recovered. You want 1,20,000 rupees. So how much more money you need to recover? Everyone answer. Everyone. You all are in a live, sir. 30,000, correct? So which means what, sir? 30,000 is more I want to recover after third year. So after third year, I want to recover only 30,000 more. Now this 30,000 I have to recover from the fourth year cash flow. So how much I have earned in fourth year, or what is the cash flow that I've got in fourth year, which is 50,000. So which means out of 50,000, I don't want exactly 50,000, because if exactly 50,000 I want, it becomes 1,40,000. I want only 1,20,000 rupees, correct? So out of 50,000, I want only 30,000, correct? So I know I have to calculate the partial year. So 3 plus what is 30 divided by 50? 30 divided by 50 is equal to 0.6. So that is the reason my answer is 3.6 years. Okay, my answer is 3.6 years. Or if at all I want to write in month na, 3 years. Now this 0.6 months have to 0.6 years have to be calculated computed in months. Sir, 1 year is equal to 12 months, correct? 1 year is equal to 12 months. So 0.6 year is equal to how much months? So basically nothing you have to do. Okay, well, nothing you have to do. You just have to multiply 12. Whatever the point number you are having, you just have to multiply 12. So 0.6 into 12 you will do, how much you will get? You will get 7.2 months. So approximately it is 7 months. Okay, approximately it is 7 months. Are you all understanding? Either you can write 3.6 years, or you can write 3 years and 7 months. So this is what is the payback period. So in the examination you can write both, just to impress the examiner, or else, okay, or else even if you're writing only 3.6 years, your answer is treated to be correct. Are you all understanding? Say yes or no. The payback period, are you all understanding? Payback period, Chalakutis. My dear Chalakutis, payback period, super. Okay, very good. Now, since you are understanding the payback period, I will just give you some questions I want you to answer, okay, ba? First question, year end cash flow. 0th year, 1 lakh. 1 to 8 years, 22,000. Second question, year cash flow. 0th year, 1,10,000. 30, 35, 20, 25, and then 35. Now please tell me the answer. I want you to solve. Okay, va? First one, what is my payback period? And second one, what is my payback period? I want you to answer. Okay, I want you to answer. Classroom problem. Okay, so first one, I'm getting the answer as 4.5 years in chats. Any other answer? Everyone 4.5? Huh? Okay, Santana also 4.5, Sujata, Anjana 4.5 years. Super. Okay, sir, how you are calculating? The formula is, or even if you are not writing the formula, even if you are doing it from the cumulative cash flow method, it is your thing. Same thing only, okay, va? Same thing, even if you can do it in the cumulative cash flow method also. But if you have a formula, or if you know, you can calculate it easy. Why you have to do? So initial cash flow divided by annual cash flow. Your initial cash flow is 1 lakh. Your annual cash flow is 22,000. So the answer is 1 lakh divided by 22,000. So the answer is 4.55 years. Okay, always write, go it for 2 digits. Now please, for second year, for second question, please tell me what is the answer. I want you to solve. Okay, take some time, don't worry. So next one, the answer is exactly 4 years. Okay, the next year the answer is exactly 4 years. Now one more thing, calculate What is the payback period if the initial cash flow is 1 lakh? Okay. So if it is 1,10,000, it is 4 years. So if it is 1 lakh, then how much? I know it is less than 4 years, but I want to know the answer. Please do it. Super, super. Very good. So I'm getting the answer as 3.6 years. Okay. So recorded students, okay, if you're watching it in the recording, please don't be lazy. Okay. I can see that a lot of people will be lazy. Don't be lazy. Try to solve it actively. Because in examination, even in final examination, they can ask payback period. Trust me. So how we have calculated, sir? First you have to put one more column called as cumulative cash flow. Okay, one more column called as cumulative cash flow. So 30k, then 30 plus 35, 65, then 65 plus 20, 85, 85 plus 25 is equal to 110, and 110 plus 35 is equal to 145. How much I want? I want 1 lakh rupees. Where it is 1 lakh rupees? It is here. Okay, so 3 plus from 85 15 it is 15. Okay, 15 divided by, so fourth year it is 25. Okay, so 15 divided by 25 is equal to 0.6. So the answer is 3.6 years. Okay, I know that you know that I know. Okay, but still we both should know. Okay, so this is what is the concept of payback period. Okay, this is what is the concept of payback period. Clarity? Super. Now let us move ahead. Okay, let us move ahead. Now I will just give you one small case study. Think and tell me. Okay, think and tell me. You are having two project proposals in front of you. Okay, here cash flow for project A and then cash flow for project B. So year 0, your initial investment is 1 lakh, and here also it is 1 lakh. 1, 2, 3, 4, 5. Okay, here it is 20,000, 30,000, 50,000, 60,000, 70,000. Here it is 20,000, 30,000, 50,000, 40,000, and then 30,000. Now based on payback period, please tell me what decision you should take. See, what is the decision rule? Now this is also I will tell you. The decision rule is accept the project where the payback period is lower. Correct? This is what is the decision rule. Accept the project where the payback period is lower. Because what is beneficial? One project in 5 years you are getting the money back. Another project in 4 years you are getting the money back. So 4-year project is a better. Because here in 4 years you are getting your money back. Are you understanding? So that is the reason the decision rule is accept the project where the payback period is lower. So now you tell me, okay, you tell me first what is the payback period for A? Please tell me what is the payback period for A? Everyone, what is the payback period for A? 3 years. Correct? Everyone, it is 3 years. What is the payback period for B? Everyone, please tell me what is the payback period for B? For 3 years. Now you guys tell me which project you will choose. A or B or indifferent. Please tell me A or B, or indifferent, sir. Anything is fine. A is also fine, B is also fine. So Santana is telling A, Malolan is telling A. Others, no indifferent. See, A also payback period is 3 years. B also payback period is 3 years. Then why you are selecting A? Please tell me the reason now. Why you are selecting A? Okay, Santan is telling 4th year 60,000 and all. Okay. Now, understand everyone. Actually, if we are seeing from the payback period perspective, both are indifferent. Just understand, if you're seeing only from the payback period perspective, I'm having a lens of payback period. So if I'm seeing this project from the lens of payback period, I will see that, sir, project A also payback period is 3 years, project B also payback period is 3 years, both are 3 years, sir. Yeah, because what is my decision? If the payback period is lower, I have to select. I have to reject if the payback period is higher. Correct? I have to reject if payback period is higher. Correct? And if it is same, it is indifferent. Sir, here the payback period is same, it is indifferent. If you are thinking like this, you will take a wrong decision. You will take a wrong decision because, now understand, now I am coming to a very important point. Now these things and all you will not see in inter and all, okay, but I will teach this in inter also. Sir, because we are having limitation in payback period. We are having a limitations in payback period. Okay, wow, limitations. Sir, what is the limitation in payback period? Alaga Gavani, the limitation is payback period is that after payback period cash flows are not considered. After payback period cash flows are not considered. Understanding, if someone is telling you, sir, this is cash flow A, this is cash flow B, which project you have to select? A Gujarati person will come and tell, hey, here also payback period is 3 years, here also payback period is 3 years, okay, and then he will tell that indifferent, you have to slap. You're telling that no, you will not select project based on this payback period. Why? Because you should also know what is the limitations of payback period. The limitation of payback period is that the after payback period cash flows are not considered. So once the payback period is done, so here the payback period is completed, afterwards all the cash flows are ignored. There is cash flow, there is no cash flow, it is all ignored. In the calculation of payback period, this is a very important limitation that we guys are having. Okay, that after payback period cash flows are not considered, are ignored basically. After payback period cash flows are ignored. But why we have to ignore and all? Okay, but these are also cash flows only. These are also we have to take it for decision making. But in payback period, this is not this is not considered itself. So this is one limitation of payback period. How many of you are understanding this limitation first? Whenever you are having some technique, you should also know what is the limitation of those techniques. Only then you will be applying that technique properly. Everyone. Okay. So this is one limitation. Okay. Now let me come to one more point. Whenever you are calculating, payback period, what you will do? You will also put a column for cumulative cash flow. Everyone understand? You will also put a column for cumulative cash flow, and then you will write it here. First year 20,000 is the cumulative cash flow. Second year what you are doing, 20 plus 30, 50,000 is the cumulative cash flow. Next year what you will do, that 50 plus 50, 1 lakh rupees is the cumulative cash flow. Correct? Now, is this correct? Just say yes or no. Is this correct? Is this correct? Yes, no. Okay, you guys are telling yes. Now understand, just yesterday I taught you, okay, wow, year 1 cash flow and year 2 cash flow cannot be added. Understanding? What is this 20 plus 30? How on earth you can add an year 1 cash flow with a year 2 cash flow? Correct? Year 1 cash flow is having a different value. Year 2 cash flow is having a different value. How on earth you can add year 1 cash flow with a year 2 cash flow? Nonsense. Are you all understanding this? Hello? Hey, this I am not telling pa. One person is actually trying to criticize payback period. I am just criticizing the technique of payback period. Are you understanding? How you are adding cash flow for the first year, second year and third year together? It is not possible. Correct. It is not correct. Finance will not allow this. The concept of time value of money will tell, hey, what you are doing. He will be laughing in the corner. Correct. The concept of time value of money. So the second limitation is that the time value of money is ignored. How can you ignore this concept? Okay, the time value of money is ignored. Why time value of money is ignored? Because different year cash flows cannot be added. Correct. A donkey should marry a donkey. A monkey should marry a monkey. Correct. A buffalo should marry a buffalo. A human should marry a human. Correct. A monkey cannot marry a donkey. A donkey cannot marry a human. Adhe mari, first year cash flow should be added with a first year cash flow. Second year cash flow should be added with a second year cash flow. Present value should be added with present value. A first year cash flow cannot be added with a second year cash flow. Correct. If you are adding first year cash flow with a second year cash flow, it means a monkey and donkey are marrying. Correct. First year is monkey, second year is donkey. Both are different values. You cannot add. So this is the second limitation. So these are the two limitations in payback period. I'm just writing the criticism. Okay, a person is criticizing. Like we are having two limitations in payback period. First, after payback period, cash flows itself are not considered. And the second one is the concept of time value of money is ignored. So for that reason, they introduced one more method, which is called as discounted payback period. They introduced one more method, which is called as discounted payback period. Okay, what he is telling is that, okay, one person is coming and telling, hey, how can you add first year cash flow with a second year cash flow? How can you add second year cash flow with a third year cash flow? You cannot add. Both are having different values. Appa I am telling, then what you have to do? First you discount this cash flow. Okay, first you discount this cash flow. If you discount, everything will come in present value, then you can add. Okay, then you can add. So let me just take an example. So I will take this example only. Sorry. So I'm copying it here, pasting it here. Now what I'm going to do here is that, let me assume my discounting rate. Okay, let me assume my discounting rate as 10%. Now what I have to do after this, okay, now what I have to do after this, because I cannot add all the cash flows, so first I have to discount. So now I don't have to do directly cumulative cash flow. First I have to do the present value factor at the rate 10%. Then I will calculate the discounted cash flows. Okay, first I will discount all the cash flows to 0th year. So what is, everyone please tell me, what is the discounting factor for 10%? 1 divided by 1.1, calculator trick, correct? So 0.909. Okay, next one 0.826 with me. Next one 0.751. Next one 0.683 and next one 0.621. Clarity. Okay, only 5 years cash flow. Now what I have to do? I have to multiply 20,000 into 0.909. How much I'm getting? 18,180. Okay. Adhe Mari, please tell me for second year, what is this? 30,000 into 0.826. How much I'm getting? 24,780. Next year 40,000 into 0.751. How much I'm getting? 30,040. Correct. Next year 50,000 into 0.683. How much? 34,150. Next year 60,000 into 0.621 is how much? 37,260. Okay, 37,260. Are you all having this clarity? Now all these cash flows are year 0 cash flows. These are all discounted cash flows. Now I can add. Correct. Now I can comfortably add. So now what I will do, cumulative discounted cash flow. So 18,180, because this cash flow now I will cumulate. Okay, 18,180, then 42,960, then 73,000, then 1,07,150, then 1,44,410. These are all what the cumulative cash flows. Now how much I want to recover? I want to recover 1,20,000 rupees. When I am recovering my money back, I am recovering between 4 and 5 years. So now my payback period is equal to, okay, my payback period 4th year, right? So 4 plus, sir, how much money extra I want, sir? From 1,07,150 I already recovered. I want to recover 1,20,000. So it is nothing but 1,20,000 minus 1,07,150. This is the extra amount I want to recover. Now this extra amount I want to recover from which amount? I want to recover this from 36,260. So please tell me, what is 1,20,000 minus 1,07,150? I am getting 4 plus, I want to recover 12,850 more. Now this 12,850 more I want to recover out of 36,260. Okay, so divided by 37,260, how much I'm getting? 0.34. So the answer is 4 plus 0.34. So it is 4.34 years. Okay, 4.34 years. So this is what is the discounted cash flow. Okay, so sorry, discounted payback period, 4.34 years. Sir, I want to do this in months. So 4.34 into 12. So 0.34 into 12 you do, you will get 4 months. So the answer is 4 years and 4 months approximately. Okay, you can also write or approximately 4 years and 4 months. Okay, so basically what you're doing is that this criticism you were having, right? Sir, time value of money is ignored. So what in payback period, you are injecting the concept of time value of money. So you are solving this limitation. Okay, you are solving this limitation and then you are introducing one more technique. So how this technique is introduced? Just by criticizing the old technique. So this is called as discounted payback period. Okay, so this is nothing but when I am getting my money back in present value terms. Okay, that is what is discounted payback period. Now everyone please tell me, how many of you are understanding the concept of discounted payback period? The conceptually, how many of you are understanding the concept of discounted payback period? Please tell yes, no, yes, no. Super. Very good, Pa. Okay. So since you're understanding, I also want to give you one question. Okay. Initial cash flow is equal to 1 lakh. No, just 1 minute. So I will also give you one question and I want you to solve that. Okay. You have to calculate both, okay? Payback period and discounted payback period, both you have to calculate. Year and then cash flows. 1, 2, 3, 4, 5 and 6. 10 lakh 20,000, 11 lakhs, 12 lakh 50,000, 14 lakh 10,000, 16 lakhs and then 20 lakh 20,000. Now everyone understand how you have to do. Whenever you have to calculate both, right? So first year cash flow. So what you will do, I'm just giving you the format. Then you will put cumulative cash flow. So from here you will calculate the payback period. And next what you have to do, present value factor at the rate. So here my present value factor at the rate is 10%. Then discounted cash flow and then cumulative discounted cash flow. Okay, if you do this, you can calculate both payback period and the discounted payback period. Okay, wow. And what is your initial cash flow? Your initial cash flow is 60 lakhs. Your initial cash flow is 60 lakhs. And just, okay, if you have, I think you have not received your hard copy till now, right? You will receive, it is already been printed. I think probably in the courier it may take 3 or 4 days more just to reach. So the hard copies and all you will get. So in the meantime, you would have got the soft copy, right? So this is the first question in the soft copy. This is the first question in the soft copy. If you have taken the printout of the soft copy, you can do it in there itself. Okay. If you are not having that, you just write this question. And please tell me what is my payback period and what is the discounted payback period. Everyone. Okay. So just to draw this table and please calculate what is the payback period and what is the discounted payback period. Everyone, I want you all to calculate this. Okay, I will not spoon feeding and doing every problem. Few problems I will do, few problems I will want in the classroom. So this is what is the exercise. Okay, I'll give you some 3 to 4 minutes of time. I think that is enough. I want everyone to write the answer in the chat box. Even though you're doing it wrong, okay, I don't have a problem. But I want you to do. Very good. I got the answer from Sadhana, others. Sorry, Sandana. Payback period I'm getting. Okay, Malolan, Sujita. So everyone is getting payback period as 4.76 years. Very good. And discounted payback period, what are you getting? Is it more than 6 years? Everyone try to solve. Tell me what is the cumulative discount cash flow for 6th year. So from there we will get to know. So how much you are recovering till 6th year? Okay. 58,72,207. I hope everyone is doing the same thing. If you're having this, also include one more seventh year, 32 lakhs. Okay, now you can tell me. You can include one more 32 lakhs just for discounted payback period purpose. Let me check. Everyone, I want you to calculate what is the discounted payback period. Okay. So if I am including one more cash flow in the seventh year as 32 lakhs, because the discount payback period is more than 6 years, right? See, in the examination, you can give a question like this also. So you have to write the answer. The discounted payback period could not be calculated because it is more than 6 years. Okay. So the answer will be more than 6 years. Or the answer is that we are not recovering the amount. Okay, we are not recovering the amount. It means what? NPV is negative in Artho. So I'm getting 6.08 years if I'm including one more cash flow for 32. In the seventh year, if I'm adding one more cash flow as 32 lakhs, just for the purpose of discounted payback period calculation alone. So how much is the answer that you're getting? Six point 08 years. Okay, was 6.08 years. I hope everyone has solved. Even recorded students, I want you to do it in the workbook. Super, 6.08 years. Okay, so everyone is getting this answer. Why I'm asking you to do is that just to, your hand should be very much comfortable with the calculations. If every problem I will do, my hands will be comfortable, your hands will be just seeing. So you should be having the practice. So trust me, the subject is all about practice. The more you do the practice, the more comfortable you become. Okay. Now, let us go on to the next one. Understand and give me the answer. Okay, understand and you have to give me the answer. Now, had you seen this question? Okay, had you seen this question? You have got the answer as 4.34 years, correct? You have got the answer as 4.34 years. So, copy and then paste it here. Now, see, everyone, this is cash flow A. Let me again write cash flow B here. Again 20, 30, 40, 50, 60. Now, sixth year, here I am having 70,000 and here I am having 20,000. Okay, here I am having 20,000. How much is my initial cash flow? My initial cash flow is 1,20,000, right? My initial cash flow is 1,20,000. Okay, my initial cash flow is 1,20,000. Now, what is my payback period? My payback period is, actually you all know, right? How much is my payback period? 20, 30, 50, 60. Okay, 3.6 years, correct? Sorry, 1 minute. 1,20,000, right? Yeah, 3.6 years. 20, 50, 90, 140. So the answer is 3.6 years. So here my payback period is 3.6 years. 3.6 years, and here also my payback period is 3.6 years. Understanding, if you're not 20 plus 30 is 50 plus 40 is 90. So 90 plus 50 is 1,40,000. So 90 and 1,40,000. So 90 lenda I want 30,000. So 30 by 50. So 30,000 divided by 50,000 is equal to 0.6. So my payback period is 3.6 years. Okay, here the payback period is actually 3.6 years. It is not 4.34. I'm not talking about discounted payback period. I'm talking about payback period. And my discounted payback period here is 4.34 years. Okay, that's what we calculated, 4.34 years. And here also it is 4.34 years. Why? Because the cash flow till 5 years are same. Till now, are you guys are understanding what we are trying to do, everyone? Okay. Yes, no, please reply. Till now, if you guys are know what I'm trying to do. Super. Now, if I'm seeing from the lens of payback period, you are indifferent, correct? Because it is same. So then you will be indifferent. If someone is asking you which project you will select, then if you're seeing it from the lens of payback period, you will say it is indifferent. You are seeing it from the lens of discounted payback period, again you will say indifferent. Why? Because even the discounted payback period for cash flow is 4.34 years, and the discounted payback period for cash flow B is also 4.34 years. Now you please tell me which project you will select, A or B or indifferent. Please tell me A or B or indifferent. Everyone, I need an answer. Cash flow A, cash flow B or indifferent. So you guys are telling A. Why cash flow A? Why cash flow A you guys have to select? Okay, so which means here we are having a limitation. Okay, wow. So we are having a limitation in discounted payback period also. Sir, what is the limitation, sir? The limitation is, again, after payback period cash flows are ignored, which is nothing but after discounted payback period. Okay, whatever. So after discounted payback period, the cash flows are ignored. Okay, so this is what is the limitation. Okay, this is what is the limitation that we are having, like after the payback period, the cash flows are ignored. So this limitation we have solved. Time value of money, okay, time value of money, this limitation we have solved. But this one limitation we have not solved. This limitation is there in discounted payback period also. So one person is coming and telling, sir, we are having cash flow A, we are having cash flow B. Which one we have to select? You will tell indifferent. Okay. Now that person will slap. Hey, see, if you're doing or if you're taking decision like this, your company will be at a loss. You have to select project A. You have to select project A. Why? Because here discounted payback period will also not work because of the limitation. So to overcome this limitation, one more method got introduced. Okay, to overcome this limitation, one more method got introduced, and that method is net present value. Sir, what, sir? Here till discounted payback period cash flow only are considered. All the cash flows are not considered, sir. So one person is coming and telling that you consider all the cash flows, pa. Okay, ma. You add all the cash flows you add. Once you consider all the cash flows, and if you minus that with initial cash flow, because if the initial cash flow is same, then you can compare discounted cash inflows. But if the initial cash flow is not same, then you have to minus. Why? Because this is also year 0 cash flows, and if you discount, that is also year 0 cash flows. So consider all the cash flows, so then you will get NPV. So net present value is nothing but discounted cash inflows minus discounted cash outflows. Okay, va? So if I take again the same example, okay, va? If I take again the same example, basically now what I have to do here is that I will just copy till here. Okay, I will just copy till here and I will paste that example here. Okay, now understand this question. Now what he is telling, only don't consider till payback period, consider all the cash flows, which means what you have to do, total this. So this is what is called as discounted cash inflow. So what is total of this? What is total of this? You know that it is 144,410. Actually the last one is nothing but the total of everything, right? 144,410. So 1,44,410. Now all the cash flows are considered. Correct, all the cash flows are considered. Now what you have to do, minus discounted cash outflow. Why? Because this is also year 0 cash flow. So I will minus the year 0 cash flow to calculate something called as net present value. So what is, so this is the present value of cash inflows. So minus cash outflow, this is the present value of the net value. Okay, va? So minus discount cash outflow. How much is my discount cash outflow? 1,20,000. So now I will get net present value. So how much is my net present value now? 1,44,410 minus 1,20,000. How much you are getting? 24,410. Are you all understanding this? 24,410. Now this 24,410 that you are getting, right? This is what is called as the net present value. So here you are overcoming this also. Now here after discount payback period cash flows are ignored. No, here no cash flow is ignored. All the cash flows are considered. Correct, no cash flow is ignored. So now if at all I want to take a decision between A and B, obviously the NPV of A will be higher and NPV of B will be lower, and then you will select A, and that is the correct decision. Correct. So that is the reason NPV is more superior than the two techniques of discounted payback period and payback period. Why? Because we understood the limitation. How many of you are understanding? And if you are understanding, what you have to do? Everyone, what you have to do if you guys are understanding? Super. Super. So now you guys are getting right from where NPV is coming into picture. Okay, so discounted cash inflows minus discounted cash outflows. Okay, discounted cash inflows minus discounted cash outflows. So here both the criticism are being taken care of. Payback period cash flow is also considered and time value of money concept is also considered. Okay, so here there is no limitation as such. Okay, as such till now there is no limitation in this NPV. So now if you are having two cash flows, calculate NPV for both and then you can select the project. Are you guys having clarity? Super. Okay, if you guys are understanding, right? Yes sir, I am understanding. Super. So if you guys are understanding, please tell me without considering the 7th year cash flow, what is the NPV here? You can directly tell what is the NPV here, which is nothing but in the 6th year cumulative discount cash flow, right? This is nothing but total discounted cash inflows minus the discounted cash outflow. You will get 1,27,007 negative, right? It should be negative, correct? Because you were telling 57 only. What is the NPV? Everyone please tell me, please calculate the NPV and tell me for the first question what is the NPV. First tell me what is the discounted cash inflows. What is the discounted cash inflows? Hey, 1.33. Okay, discounted cash inflows is 58 lakh 87,000, correct? 58 lakh 72,207. 58 lakh. You guys are only telling, okay, 58 lakh 72,207. 58 lakh 72,207. Is this correct? Others, yeah, others can also confirm. 58 lakh 70,000. Okay, wow. So probably someone would have taken 3 digits, someone would have taken 4 digits. See, I will tell you, okay, but just to uniformity, okay, just for the uniformity, whenever the value in lakhs, never take 2 decimals and all. Okay, never take 2 decimals, otherwise you will get wrong. So much rounding off will happen. Sir, how much round off we have to do? How much round off we have to do? The round off that you can give to a beggar. Okay, wow. For example, 58 lakh 72,207. Sometime before rounding off, you will get 200. So 7 rupees is the difference. In exam, there will be no problem. If the difference is 7 rupees, 10 rupees, 50 rupees, 100 rupees, okay, there is no problem. But if the difference is 10,000, 20,000, okay, like 58, 72,000 and one person got 58, 67,000. So which means you have taken 2 digits. See the difference, 67 and 72. Okay, it is some 5,000 rupees difference. So this difference is not acceptable in the exam because 5,000 rupees is a huge difference. Can you give 5,000 rupees to a beggar? If you're so generous, then okay, you can take the decimals. But okay, I'm just giving you just an example. So you should be taking always 3 decimal or 4 decimal, okay, based on the number. So it is in 10 lakhs, right? So better to take 4 decimals because 10 lakhs values are there, okay. But if it is in thousands, then you take 3 decimals. I'm just giving you a bird's eye view. Usually in the question, the discounting factors will be given. So whenever the discounting factor is given, then don't question the question. Whatever given in the question, take it, okay. Then you don't calculate, okay. Then you don't calculate. But if you're not taking like that, then it will be a problem, okay. So because it is lakhs, you take 4 decimal. Even if you're taking 3 decimal, it is not a problem. So this is what is the 58 lakh 70,000 discount cash inflows minus 60 lakhs. So if you do minus 60 lakhs, what is the NPV? Your NPV is 58,72,207 minus 60 lakhs is equal to 58 lakh 72,207. You are getting negative, okay, 1,27,793. Okay, wow. So this is what is the negative NPV. How many of you are understanding this? Please give yes. If you're understanding, please write yes. Correct. These are small mistakes that people will do in the examination. You don't know this mistake will take 1 or 2 marks. So why you want to give 1 or 2 marks for this blunders? Okay. So always don't worry, pa. What is for 5 seconds extra it will take, right? Just to write one more decimal. But don't worry, that 5 second extra should not lose you 2 marks. Okay. So now your understanding means I will give you a question. Here, cash flow A and then cash flow B. Zeroth year, 1,20,000, 1 lakh, 1, 2, 3, 4, 5. First year 30, 60, 40, 20, 30, 10, 50, 15, 60, and then 50. Okay, ba? So please, the discounting rate is equal to 10 percentage. Please tell me what is the NPV for this two cash flows. So how you have to do table? Okay, table year, cash flow A, present value factor, discounted cash flow A, and then discounted cash flow B. Okay, well, like that you have to do. Zeroth year you ignore, 1, 2, 3, 4, 5, everything you do. Or zeroth year, even if you're writing, it is not a problem, but you have to make it negative. And then the total will be NPV. So please tell me what is the NPV for A and B. Everyone, I want everyone to solve and give me. See, I'm just, because you guys have not solved problems, right? For a lot of months you have not done this, so that is the reason this will be like a practice things for you. So I'm getting some answer 34,190. Yeah, 34,190 is one answer that I'm getting. Take 3 digits. Okay, well, no problem, you take 3 digits, but last digit you always round off. This mistake you should not do. This is not at all an acceptable mistake. Lot of people, what they will do now, last digit they will not round off. Last digit you have to round off. You take 3 digit or 4 digit, but last digit you have to round off. For B, okay, someone is getting 34,272, no problem. Okay, 100 rupees difference, no problem. Okay, 100 rupees we can give it to the beggar, right? Generously, so no problem. And then for B, we are getting 19,877. Others, yeah, I also want everyone to solve. Okay, everyone I want you to solve. Okay, 19,815, no problem. Okay, 19,815, just 50 rupees difference, right? 50, 60 rupees difference. So we can give it, no problem. Thirty-four 272. Great, Anjana. Okay. Malolan. Okay. Super. Okay. Now you guys are thinking that, sir, why are you making you solve, sir? Sir, we are very tired, sir. This practice you should be having. Take it from me. This discounted cash flow calculation, not one time. In the entire batch, you will be doing 500 times. Okay, 500 times till your examination. 500 discounting table you will draw. Okay, because this is the most important thing. So you should be having proper practice, no mistake. There is no chance of mistake in calculating discounted cash flows and all. Okay, discounting should be your left hand job. If you're already writing in the left hand, then the right hand job. With me? Okay. Okay, sir. Now we are getting NPV. Okay, we are getting NPV. Sir, which means you are telling that, okay, now everyone, okay, now thinking time started. Sir, you are telling for NPV, okay, for discounted payback period also decision rule you know, right? Decision rule, the decision rule you know. Accept if discounted payback period is lower, reject if discounted payback period is higher. Okay, now for NPV, what is the decision rule? The decision rule is accept if NPV is positive. Yeah, if you're having a project and if your NPV itself is positive, accept if there is one. Okay, if there is one project. If you're having only one project and if someone is asking you to select, then accept if the NPV is positive. Reject if the NPV is negative. Okay, and indifferent if the NPV is 0. Sometimes indifferent, sometimes you can also reject. NPV itself is 0, then you can directly call reject, but okay, conceptually it is indifferent. But sometimes, okay, in some book they will also write reject NPV 0, but conceptually it is indifferent. But if you're having more than one project, then accept, like both are positive. Then how? Two projects, both are positive. Then accept where the NPV is higher. Reject if the NPV is lower. So if A is lower, reject. And indifferent if the NPV is equal or if the NPV is same. Okay, wow. So this is what is the decision rule for NPV. So if they've given only one project and if they're asking you to select whether I should accept or reject this project, okay, then you have to do. What ICP is different? What is ICP? See, even you're talking about initial cash flow. Even if the initial cash flow is different, you have considered in the NPV calculation, right? Your NPV calculation is having the initial cash flow impact. So there is no problem. Even if the initial cash flows are different, your NPV is giving impact. Had here also the initial cash flow is 1,20,000, This becomes 20,000 less and this becomes negative. Okay, wow. Now everyone understand. Okay, now everyone understand. I will come to a lot of points. Okay, I'll come to a lot of points. Now this is the decision rule. Are you guys are understanding? Just say yes, no. Yes, no if you guys are understanding. Accepting yes, sir. Super. Okay. Now let me just ask you a question. Sir, which means what you are trying to tell is that NPV is equal to discounted cash inflows minus discounted cash outflows. Correct? This is what we will call it as NPV. Okay. So now let me give you a small example. Sir, discounted cash inflow and discounted cash outflow and NPV. So I am having cash flow A and then I am having cash flow B. So what is the discounted cash inflow for cash flow A? It is 1 lakh rupees. Okay, directly I am discounting and I am directly telling. My discounted cash outflow is 95,000. Okay, for project A and project B. For project B, my discounted cash inflow is 10,000 and discounted cash outflow is 9,000. Okay. And what is my NPV? My NPV here is 5,000 and my NPV here is 10,000 minus 9,000, 1,000. Now you all please tell me which project you will select. Please tell me which project you will select. Okay. Everyone is telling, sir, we will select project A. Understanding? You guys are telling, sir, project A. Super. Now everyone understand. You guys are telling project A. Why? NPV rule, sir. Sir, wherever I am having more than one project, if the NPV is higher, that project I will select. But now understand, if you are taking decision like this, company nadu therila vanda nikkum. How? Understand now. See, cash flow A. You are investing 95,000 rupees. You are investing 95,000 rupees and you are getting an inflow, discounted cash inflow of 1 lakh. This is discounted, okay, present value terms only. And if you see project B, only 9,000 rupees you are investing and you are getting discounted cash inflow of 10,000. Just assume project B ni 10 times potrukka. So with a 90,000 investment, you are already recovering 1 lakh. So 10,000 into 10 is 1 lakh. So still 5,000 rupees you are having extra. Understand which is more profitable? Which is more profitable, A or B? Which is more profitable, A or B? B. Everyone understanding? See, what I am trying to tell here is that, sir, here, okay, here, 95,000 investment, your discounted cash inflow is 1 lakh. Assume that this you have invested 10 times. Upon discount cash inflow will also become 10 times. Sir, appadina here 90,000 investment ayiruchina, here you will get 1 lakh rupees. Both here 1 lakh and 1 lakh is same. Now assume, sir, 90,000 use pannita I am getting 1 lakh rupees. And here 95,000 use pannita I am getting 1 lakh rupees. Which is better, A or B? Understanding, sir? Investing 95,000 rupees and getting 1 lakh rupees or investing 90,000 rupees and getting 1 lakh rupees, which is better? A or B? B is better. Understanding? Sir, appadina NPV is also having a limitation. Sir, understand? NPV is also, someone is giving a decision using NPV. We are just coming and we are just giving a slap and we are telling that, hey, we are having a limitation. So what is the limitation in NPV? What is the limitation of NPV? NPV considers only absolute value. So it will give you the absolute return. This project will give you 5,000 rupees of return. and this project will give you 1000 rupees of return. That's it. NPV considers only absolute value. Okay, it does not consider profitability, or it is also called as relative value. Okay, wow. It considers only absolute value. It does not consider the profitability of the project. It does not consider the relative value of the project. It will just consider the absolute value. Project A invest panna 5000 kadeko, project B invest panna 1000 kadeko. That's it. But enna pottu you are getting 5000 rupees. What you are investing and you are getting 5000 rupees, that index number you don't know. Now what I am trying to do is that for 1 rupee of investment, what is the return that I am getting? For 1 rupee of investment, what is the discounted cash inflows that I'm getting? So now what I'm doing here is that, now what I will do here, okay, same thing, I'll just copy. Okay, paste it here. Now see, everyone understand. Now what I'm going to do here is that I will not minus. Okay, I will not minus. Instead, what I will do, I will divide. Now basically when you're dividing, what you're having, when you're dividing, what is happening is that discounted cash outflow is divided, which means 1 lakh divided by 95,000 means what? For every 1 rupee of investment, what is the discounted cash inflow that you're getting? Correct, sir. 50 rupees samosa divided by 5 samosa. So 1 samosa is 10 rupees. So this you are unitizing it. Whatever it is in the denominator, you are unitizing it. For 1, how much? Correct. So adhe mari, for 1 rupee of discounted cash outflow, what is the inflow? Understanding? For 1 rupee of discounted cash outflow, how much is the inflow? So now what you are doing, you will dividing. So please tell me what is the discounted cash inflows divided by discounted cash outflow for A? 1 lakh divided by 95,000. How much you are getting? 1 lakh divided by 95,000. You are getting 1.05 pa. It is not 0.95. I am not doing outflow divided by inflow. I am doing inflow divided by outflow. And here next one, 10,000 divided by 9,000. How much you are getting? 1.11. Correct? Now understand what is the interpretation of this number. The interpretation of this number is that, sir, here for every 1 rupee of investment, I am generating 1.05 of discounted cash inflow. For every 1 rupee of investment, I am generating 1 lakh rupees of discounted cash inflow. Sir, 1 rupee pota 1.05 rupees kadekudhu. Appa 95 rupees pota evlo kadeko? 95,000 into 1.05, you will get 1 lakh rupees. Understanding? So 95,000 into 1.05 you will do, you will get this 1 lakh rupees. Okay, just, sir, in project B, if I'm investing 1 rupee, I'm getting 1.11 rupees. If I'm investing 1 rupee, I'm getting 1.11 rupees. Appa 9,000 rupees invest panna evlo varo? I will get 10,000 rupees. Understanding? Sir, which means which project is better now? Project A or project B? Please answer. Project A is better or project B is better? Project B is better. Understanding? Sir, now what is this called? This is called as profitability. Okay, profitability index. This is called as profitability index. So from the limitation of NPV, we have told you one more method of which is called as profitability index. Now this tell me, if you are having 2 projects in front of us, we are just checking the profitability. Sir, because both the project size are different. So because the size are different, absolute value there will be a huge difference. But the relative size we have to see. Okay, va? So here you see, this is a small project. This is just a 9,000 rupees project. This is a large project. So I have to see the relativity also, right? So now what I am doing here is that, okay, va? So obviously large project will have large return, less project will have less return. You will check just profit. Small company, I am having 1,000 rupees profit. Reliance company, it is having 1 crore rupees project profit. You will tell Reliance is big, but you cannot tell Reliance is profitable. There is a possibility investing just 2,000 rupees. I have actually took a profit of 1,000. They would have invested thousands of crores of rupees and just earned 1 crore rupees, correct? So now this is what is called as profitability index. Okay, profitability index. It is an index number. Basically, I'm unitizing the outflow. So now for every 1 rupee of outflow, I am generating 1.05 rupees of inflow, and for every 1 rupee of outflow investment, I am generating 1.11. So here, if I invest, it is better. Project B, if I invest. So whenever I am having money, first I will put in project B. Here I am getting 1.11. Then if project B is completed, now I will go for project A. Okay, so this is how I have to take a decision. Okay, this is how I have to take a decision, and this is called as profitability index. Okay, this is called as profitability index. Okay, so NPV consider only absolute value, it does not consider the profitability value. So based on NPV, okay, based on NPV, one will select project A, but project B is more profitable. Okay, so that is the reason here introducing, okay, here our hero is coming here introducing profitability index. Okay, this will not give me absolute profit, this will not give me absolute profit, but an index number to compare, Okay, so profitability index is equal to discounted cash inflow divided by discounted cash outflow. Okay, profitability index is equal to discounted cash inflows divided by discounted cash outflows. This is what is profitability index. Okay, so just if I want to see the decision rule, okay, how it will be, sir, discounted cash inflow minus discounted cash outflow is NPV. Discounted cash inflow divided by discounted cash outflow is profitability index. Sir, what is the decision rule for one project? Positive accept, negative reject, 0 na it is indifferent. Sir, profitability index na how I have to take a decision? If it is more than 1, then always your NPV will be positive, correct? So if because you understand, discounted cash inflow 1 lakh, if the discounted cash inflow is more than discounted cash outflow, always my profitability index will be more than 1. So whenever it is more than 1, always my NPV will be positive. Understand, if my discounted cash inflow is 8,000, so 8,000 minus 9,000 is -1, and also 8,000 divided by 9,000 is 0.87 or 0.88, sorry, 89. So that is what is negative. So profitability index, now if it is more than 1, accept, if it is less than 1, reject, and if it is equal to 1, then which means it is indifferent. Sir, why sir? If your discounted cash inflow and discounted cash outflow both are same, understand, both are same, then your profitability index will be equal to 1, and also your NPV will be 0, because inflow outflow both are same, it is 0, NPV is 0, and NPV is 0, profitability index is equal to 1. Okay, so this is just a comparison, okay, just a overview of how you have to see NPV and profitability index together. So you can understand, if your profitability index is more than 1, which means your NPV will be positive. If your profitability index is less than 1, which means your NPV is negative. If your profitability index is equal to 1, which means your NPV is equal to 0. You know, sometimes in the question twist panni kepanga, there is some project where the profitability index is equal to 1 and blah 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 blah. Now whenever the profitability index is equal to 1, you have to write the equation. If the profitability index is equal to 1, which means discounted cash inflow equal to discounted cash outflow. Okay, how many of you are having this clarity? Just say yes, no. Having this clarity, everyone? Super. From the limitation we are learning, okay, from the limitation, okay, where profitability, actually usually project should be seeing in silo only, okay, I'm telling practically project should be seen in silo. Silo means separately. So NPV only is a better terms. But whenever we are having lot of projects and whenever we are having option to select the project, whenever we are having lot of projects and whenever we are having option to select the project, their profitability index should be used. Which means if you are having limited capital, if you are having lot of capital, na go pa. If you are having unlimited capital, then definitely you have to invest here. Okay, because 5,000 you are getting, then you should not see profit, you should see more money, right? If I'm having 95,000 rupees, I will go and invest in project A, assuming project B is only one time, if I have to select between the one. But if I'm having a limited capital, okay, and I have to choose, then I will select B. For example, if I have to take a loan and then I have to put, then I will choose B. Understanding? Okay, so which means profitability index application is in capital rationing decisions. Okay, wow. Capital rationing decisions. Sir, what is capital rationing decisions, pa? Capital rationing decision is again an investment decision only. It is an investment decision with limited capital. With limited capital. For example, sir, I am having only 2 lakh rupees and I am having in front of me some 8 projects. 1, 2, 3, 4, 5, 6, 7, 8. Here 1 lakh this is the here 2 lakh this is, here 50,000 this, here 60,000 this. Now I have to choose which and all project I have to select, which means ranking needs to be done, right? So ranking based on, okay, wow. So ranking should be based on profitability index. So first you will calculate the profitability index for all, then you will put a ranking. So third project, first ranking, more profitable index, not based on NPV. Ranking should be based on profitability index, and based on the profitability index you have to invest the amount, only then you will get the highest NPV. Okay, wow. So there this profitability index is very much useful in capital rationing decisions. Okay, so profitability index application is in capital rationing decision. What is capital rationing decision? Investment decision with limited capital, where ranking should be based on the profitability index. Okay, so this is the clarity that you guys should be having. Okay, capital rationing decisions. Yeah, yesterday, okay, yesterday few students were telling me that the time was 6:30 to 8:30, and the few were telling 6:30 to 9. See, actually the time is 6:30 to 9 only. Okay, 6:30 to 9. So if there is any confusion, probably it's a revised timing, you can say 6:30 to 9. Only then a proper 2.5 hours class will be there. Okay, but since I understand lot of students wants to go to office, we can come at a middle ground. Okay, we can, I will I will complete the class in 8:45. Is that okay for you all? 8:45, is that okay for you all? 8:45 we can close the class. Then are you all will be comfortable? Okay, just for you guys, pa, because few people have messaged, right, sir, 9 o'clock it is difficult office timing. So 8:45 will close, not a problem. Actually, if we are taking till 8:30 na, hours will be very much less. Okay, for it will just be a 2 hours class. Actually it is till 9. Okay, but we will compensate it in the weekend. Weekend on a I will just teach you. Okay, so weekend we will compensate, there is no problem. So we can close the classes 8:45. Okay, for the benefit of students who are going in the offices. Okay, so you don't have to worry about all these things. Okay, sir, now what and all things we did today? We understood payback period, then we saw two limitations. Based on the limitation, we introduced a method called as discounted payback period. There we saw a limitation like after payback period cash flows were not considered. Then we calculated a net present value. Okay, and then we calculated profitability index. Okay, so these are all the 4 techniques that we studied today, with concepts and with problems. Okay, with concepts and with problems. So basically payback period is completed. discounted payback period is completed, net present value is completed, and profitability index is completed. Okay. Sir, what is accounting rate of return? Accounting rate of return is basically nothing but return divided by investment. Okay, ba? Return divided by investment. If only 1 year data is given, then return divided by investment. If multiple years data is given, then average return divided by average investment. So basically it is all about profit. Okay, average profit. So everything is financial management. Idu mattu accounts. This is what is accounts. Basically in finance we will not even consider profit. This is the only technique where profit is considered. Okay, so accounting profit, okay, average return divided by average investment, nothing great is here. Okay, average accounting rate of return, nothing great is there. Okay, now talking about internal rate of return. Okay, since time is less, because internal rate of return I will require more time, so this we can continue tomorrow with a fresh mind. Okay, internal rate of return, modified IRR, modified NPV, adjusted NPV, all the concepts and lot of problems we are going to see in the next session. Okay, next session. And if you have not taken the printout of the workbook, you can take the printout of the workbook, because we will be solving problems also tomorrow. Are you all with me? Say yes, no. Hello. Okay. Super. So now you know how to have a profitability index also. Okay. So now next one, what we could be doing now is that I will just give you one small thing to understand. Okay, one small thing to understand. This payback period, discounted payback period, NPV and profitability index. Okay, adula NPV is the most important thing. Why? Because most of the investment decision we will be using net present value. That is a more superior approach than all the approaches. More superior approach, because you saw what is the limitation in payback period, you saw what is the limitation in discounted payback period, you also saw the limitation in NPV. So adanada we are calculating profitability index, but profitability index application is mostly there in capital raising decisions. Okay, but if you want to take an individual decision, and mostly in investment decision we will take individual decision only. So if we have to take individual decision, then we will be using this net present value method. Okay, then we will be using this net present value method. Always understand, for calculating everything that we have calculated, right, we have calculated in cash flows. We have calculated in cash flows, and we have not calculated in profits. We have calculated in cash flows and we have not calculated that in profits. This is the most important thing. Sir, how to calculate cash flows? Sir, if profit is given, how to come to the cash flow? This is the next point. If profit is given, then how to calculate the cash flow? Already you know, I'm just revising. Okay, for example, cash flow means what? All the non-cash expenditure should be added back. So basically, if you are having profit before depreciation and taxes, so this is profit before depreciation and taxes. Let us say you are having 20 lakhs. Then what you have to do? You have to reduce depreciation. Let us say depreciation is 5 lakhs. So this is profit before interest and tax. So let me call it as EBITDA, profit before interest, depreciation and taxes. It is also called as EBITDA, 20 lakhs. Then minus depreciation, you will get EBIT, because depreciation is minus, right? So EBIT is 15 lakhs. Now again minus interest, 5 lakhs. Assume. Then earnings before tax is 10 lakhs. Then let's say you are having tax at the rate 50%. So which means 5 lakh. So you are having profit after taxes of 5 lakhs. This you know, okay, nothing but income statement. EBITDA minus depreciation, EBIT minus interest, EBT minus tax, PAT. If minus preference dividend, then again earnings available to the equity shareholders. All these things you know. PAT, if you are adding the depreciation, PAT plus depreciation. So how much is the depreciation? 5 lakh. This is what we call it as cash flow after tax. So this is profit after tax and this is cash flow after tax, which is 10 lakh rupees. So this is what is the most important thing. Sorry. Cash flow after tax, which is 10 lakh rupees. So this is what is the most important thing. Okay, cash flow after taxes. For all the things you have to calculate cash flow after taxes. The CFAT is the most important thing. Cash flow after taxes. So one simple way to calculate cash flow after taxes is that from the PAT you add the non-cash expenditure. Mostly the non-cash expenditure is depreciation only. Now you guys will be thinking that, sir, here you are reducing depreciation and here you are adding depreciation. Instead, don't consider at one place you are reducing, at one place you are adding. It is same impact only, na? It is not the same impact. Understand, depreciation is not directly affecting your cash flow, but depreciation is indirectly affecting your cash flow. How, sir? Depreciation is not a cash flow, but depreciation is an acceptable deduction in income tax. Now, because it is an acceptable deduction in income tax, what will happen? Depreciation will give you some tax benefit. Because of depreciation, your profit is reducing. Because your profit is reducing, your tax is reduced. Had the depreciation not been there, your tax would be more. Now, because of depreciation, you are having that savings in taxes. That savings in taxes is what is called as tax shield on depreciation. If depreciation is not there, assume if depreciation is not there, your EBIT will be 20. Yeah? If depreciation is not there, now your EBIT will be 20. Your interest will be, EBT will be 15 lakh. And how much will be your tax? 7.5 lakh rupees will be your tax. Correct? So, had there is no depreciation, 7.5 lakh tax you have to pay. Now, because there is depreciation, 5 lakh rupees tax you are paying. So, because of depreciation, 2.5 lakh rupees tax saving that you are getting. Correct? Because of depreciation, 2.5 lakh rupees is the tax saving that you are getting. Understanding, a 2.5 lakh rupees is the tax saving that you are getting. So, 15 minus 7.5 is 7.5. So, this 7.5 is the profit. Otherwise, if you add 2.5 lakh rupees tax benefit, again this is also cash flow after taxes 10 lakhs. Two way of calculating, correct? One way is PAT plus depreciation. That is the easiest way. And the second one is ignore depreciation and then add a tax shield on depreciation. Tax shield on, instead of depreciation you have to add tax shield on depreciation. So that is what will give you 10 lakh rupees. Okay, so which means, sir, depreciation is a non-cash expenditure. Depreciation is not directly affecting your cash flow, but depreciation is indirectly affecting your cash flow through taxes. It's a very important point. Okay, depreciation is a non-cash expenditure. It does not directly affect the cash flow, but it indirectly affects cash flow through taxes, which is called as tax shield or tax benefit on depreciation. Okay, or tax benefit because of depreciation. Okay, very important point. Okay, very important point. Clarity. So this is how you have to calculate the cash flow. So more about cash flows and more about the other techniques we are going to see in the next class. I hope you have enjoyed the today's session. Lot of things we have discussed. Conceptually, we are just building the foundation, and slowly we will be advancing with more and more concepts. Please tell me, have you enjoyed today's session? Hello, I need a reply. Have you enjoyed today's session? Super. Every day, okay, this enjoyment should be continuing every day and with the same level of excitement. Okay, with the same level of excitement, I want you to come to tomorrow's class, and then we will be, okay, tomorrow, because it is a Saturday, so it will be a half day class. Okay, it will be tomorrow Saturday, right? Yeah, it will be a half day class. So we will be there for 6 hours together, and then definitely we'll be solving a lot of problems, and a very good coverage will be there in the tomorrow's class. Okay, so I hope tomorrow you all will be available. So thank you very much. See you all in tomorrow's session. Hope you have enjoyed today's session. So with the same excitement, we'll be continuing tomorrow's class. Thank you very much. Tata, bye bye.